we've had some data out from South Africa this morning. We've had the producer price inflation number, which came out quite sharply low, down from 6.6% down to 5.4%. But let's concentrate on something else now. Private sector credit extension. You can't pick up a newspaper now, you can't listen to the radio, look at the internet with anything to do with South African economy and find that there isn't something about unsecured lending. Now, the private sector credit extension number came out today, and it's also focusing on that. Let me just read you something here. It says the decline in the growth rate of PSCE was on account of slower borrowing by the corporate sector as growth in household borrowing increased. And our next guest put out a report which he kindly sent me this morning, and it says the following: household sector credit growth is gradually becoming more troublesome due to very strong growth in non-mortgage household borrowing. It's John Loos, household and property sector strategist at FNB. He's in the Power Lunch studio in Johannesburg. John, you sound a note of caution right at the beginning of your report. How bad is it getting potentially?
Well, Lindsay, as yet, I think you've got to take it in, you've got to understand where I'm coming from. The debt to disposable income ratio in this country is already high. If it was a decade ago, I would say 8.1% year-on-year growth in household credit, that's the July number, and it's accelerating, wouldn't be a problem because the debt to disposable income ratio was far lower. But we're now at a stage where we're a highly indebted household sector, I think too high. It has come off a bit from 83% peak a few years ago down to 74.7%. But I believe that that debt ratio should be significantly below 70% at least for the household sector to regain its financial health. Given that background, this accelerating growth rate to a level where at the moment, if you look at the second quarter GDP figures, 8.1% total wage bill growth for the country. If that's a good indicator of what's to come for the disposable income growth figures, that's more or less in line now with household credit growth. So what it means is we probably won't make much, if any, progress in further lowering that debt to disposable income ratio, and that's the big problem for me.
Okay, so 83% down to essentially 75%. 75%, in your opinion, is too high. Give us some, contextualize that number. A decade ago, was it around about the 50% level? I mean, how far have we come in terms of our indebtedness?
It bottomed out at somewhere in the 50s earlier in last decade, yes. It goes in cycles. It was quite high in the late 1990s, and after that interest rate shock, it came down quite nicely to early last decade, and then started rising again very sharply as that whole consumer and property boom gathered speed. It was always probably going to do that, given that we had this massive reduction in interest rates. If it costs less to service each rand of debt, you would take on more. But I think when we look back now, although we'd all expected that debt to disposable income ratio to rise during the boom, I think 83% was too far. And I think, you know, it's subjective, but I think that a better or a healthier peak, which would have alleviated a lot of the pain that we felt after the boom, would have possibly been something like 70%.
Unfair, of course, to compare us to places like Australia, because we are at different stages of an economic cycle and we're at a different stage of our country's development. But I think if you look at Australia, isn't it something like 120%, which is extraordinary? At
one stage, Australia was near to 150%, and the US and a lot of the developed world economies were up in the 130s, 140s. But bear in mind, higher income people have the ability to have higher debt ratios. So if you split up our income groups, the BMR has from time to time done some work on that. Higher income groups in South Africa too have debt to disposable income ratios of well over 100% often. It's more the lower income groups that keep the average down, and we've got a lot more of them in this developing country. They typically can't service as higher debt ratios because they've got far less discretionary spending.
Let's have a look at the numbers now. You mentioned 8.1%. That rose from the previous month, June. I think it was a 7.7%. It's not the nature of the growth or the number, because, I mean, the PSCE number has been far, far higher in the days pre-National Credit Act for all sorts of different reasons. But what you're worried about is the type of borrowing that is being taken on. And I did speak to a banker the other day, John, and he said that somebody will take a loan. The loan will be bigger than normal. It will be longer than normal. And then they get into a little bit of trouble, and then they go to another bank and take another loan. Now that is sort of growing the customer base of the banks, but it's the same person at 2, sometimes even 3 different institutions. And he said it is becoming a problem.
It seems to be. I think banks are grappling to get a grip on the extent of the problem. When they analyse individual borrowers. I'm just more of a macroeconomist type. I look at the overall number and I say if you strip out mortgage borrowing growth, which is very low, and that's the only thing really now keeping the overall household credit growth number down at reasonable levels. If you take that out, all non-mortgage credit to households is growing at in the region of 21.2% year on year. In a weak economy, that I find hard to swallow. It looks very extreme to me. It's not only about personal loans. Installment sales credits is somewhere around about, I think, 14-15%. Credit card growth is very strong. So all of those components of non-mortgage lending have been gathering steam in recent times.
Yes, and it's also very telling that the big story of 48 hours ago was the fact that the Minister of Finance had called in some of the top bankers to say, look, what is the situation? Are you worried? Because I'm a little bit worried because of what I hear anecdotally and statistically as well. Do you think they will go back to their desks now and go to their divisions and say, OK, let's curb this a little bit. Let's be a bit careful with this one?
I suspect something will happen. I think that so-called verbal intervention by whether it's the Minister of Finance or from time to time the Governor of the Reserve Bank in various ways, I think it does have some effect. But Lindsay, I think what lenders can tighten the screws and curb credit growth. It's possible, but I'm not sure that is the ultimate solution. There seems to be an obsession with debt. And it seems a case of whatever the bank is going to give, the borrower is going to take. And that culture really needs to change because the one thing banks can't address really is the savings rate. They can curb the level of borrowing growth, but even then, that's only part of the solution. Our net savings rate is at 0% of disposable income at the moment. So it's the gross savings that exist just covers depreciation on fixed assets. That's not good enough. We hear a lot of reports about a lot of people being ill prepared for retirement. That savings rate has to go up. Now, even if you cut borrowing, that doesn't necessarily address savings. People can have no debt whatsoever and just spend everything they earn. And there's not much a bank can do about that. So the whole culture towards households' own finances somehow needs to change. It's I don't pretend to have the solution for it, but we've really got into this consumer, this high consumption, low savings culture, which is typical of many Western countries, and it's a long-term problem.
Just very quickly, before we get on to corporate debt for the last 30 seconds or so, just tell me something. The type of banks or the type of interest rates being charged by banks for some of these unsecured loans are extremely high, maybe something between 25 and 30%, something like that, in some cases even higher. Are those fixed rates? In other words, if interest rates come down at the next Reserve Bank meeting, does that increase the borrower's ability to pay back those loans, or because it's fixed, it absolutely doesn't matter?
Lindsay, I'd be lying if I gave you a decent answer on that as to what percentage of loans are fixed versus floating rates. I unfortunately work at FNB Home Loans, and my knowledge is limited. There are certain fixed rates. On vehicle loans, you do get a certain portion that are fixed rates, but I wouldn't be able to give you an answer offhand as to how much of the lending is fixed.
OK, well, let's move on then to the corporate side of this private sector credit extension number that came out today. Corporate lending has gone down. Is that because of the time of year? Is it seasonally adjusted? What are the implications of that drawdown?
I think we need to, I'm not surprised that's perhaps coming down a little. We just have to look at the state of the economy. The economic growth rate in the second quarter did go up slightly, but that was largely the result of a normalization of mining output after first quarter disruptions. You take that out of the equation and you see an economy that's starting to feel the pressure of weakening global growth in recent times. So I guess it shouldn't be altogether surprising that perhaps corporates are becoming more cautious in their borrowing habits as well. It's more a sign of the economic times of the world, I think, than seasonal factors.
Speaking of cautious, very final question, John. You sound very cautious. I mean, I can see from the tone of the report that you sent me today about PSCE that, in a broader sense, you may be a little bit concerned about the progress of the South African economy.
Yes. Well, I mean, I think many economists have been concerned about it for a long time. We tend to spend a lot of time, and I've alluded to the world economy being a big influence on us, and we're a big export-driven economy, so it always is going to be. But it really is time for us to start making our own structural changes to grow our economy stronger in the long term. It doesn't mean we'd get away from these global cycles, but really we can't rely on the developed world, I think, for a few years. They're in a bad way themselves, many of those countries, Europe, and I think the USA's even got more issues than it cares to admit. So we've got to make our own structural change, China style, India style, which means that instead of, you know, if you made those changes and those positive changes, you would, instead of slowing from 3% to 1% growth, as we often do, you might slow from 8% to 7% or to 5%, which would be a better situation. So we can't get away from the economic cycles. But what concerns me more is we're not making those very positive structural changes to our economy.